Target is just giving everything away.
I was thinking about that. I'm in the market for a new flat screen TV. I was thinking maybe I should go to Target.
Target, everything's 40% off at Target right now.
Hello again, everybody. It's your boy Chicago Sean McLaughlin. I'm the chief option strategist at All Star Charts, and I'm joined by our head technical analyst, Steve Straza, once again. What's up, Steve?
Let's go, man.
Oh, man, 2 days in a row, man. I don't know who's luckier, me or our audience. This is great. All right, so we got Straza there on screen. We got Brandon behind the scenes. Shout out to Brandon, always doing a great job. Straza is going to man the screen here. He's going to share all the beautiful pictures we got for you. We're going to talk about our trade of the week that we put on today, our options trade of the week. It's in a name, it's in a sector, it's in an ETF that we've been talking about quite a bit over the last, feels like a couple of months. Just the implied volatility and the volatility just in general of the consumer discretionary stocks has been pretty up there, right?
Yeah, I mean, this is probably one of the most beat up sectors. So what is the play here? What are you trying to do here?
Well, you're just jumping way ahead, man. I was trying to set the table, but yeah, we're trying to sell some volatility here. We're options traders. We want to sell some juicy premium here. Of all the ETFs that we track on the board right now, XLY has the highest implied volatility, and it's not that surprising. I mean, if you scroll up a little bit, so we can see that chart there. I mean, we had a big sell-off in XLY recently. I mean, pretty much all year it's been a pretty big fade, and it scared a lot of people, right? I mean, we had retail stocks. I'm not sure if they qualify as discretionary, but Walmart and Target recently scared people. Are they in this ETF?
Most of them are. Some of them fall under staples.
Okay. All right. Makes sense. But look, the fear, if there's any fear anywhere in the market right now, it feels like it's kind of in this space right here. The implied volatility tells the story. We are currently in the upper range of the volatility, the implied volatility where it's been all year. If you want to scroll that up there, bring up that little chart. Ooh, our chart disappeared. There it is. That's how implied volatility has trended since October. And as you can see, we are near the upper end of the range. And what does that mean for options traders? That means that the premiums being priced into options in this underlying are expensive, relatively expensive. And they're expensive because people are afraid. They're either afraid or they're making some really speculative bets. My bet is that they're more afraid than anything else. And as options traders, we want to take advantage of that. So that's what we're trying to do here today.
I mean, listen, we talked about it yesterday, right? It seems like every morning I come in and hear about another retailer that's lowered guidance, cut guidance, put out bad earnings, whatever it might be, just releasing bad news, negative headlines, and is down 15-20%. And it's right. Biggest name too. Walmart and Amazon, sometimes they are immune to these economic downturns. Not this time.
Right. And so because of that backdrop, because of the fact that we have, at least stocks that make up this index, that make up this ETF, that we've seen some significant gaps, some surprise gaps. Because of that, we want to participate in the delta neutral trade here, but we want to define our risk. We don't want to take on any naked risk here. So instead of just selling puts and selling calls like in a traditional strangle type trade, which is what I like to do a lot of, we are going to do an iron condor. And if you zoom in on that chart there that Strass has got on the screen, it's a four-legged trade for those of you who are familiar with an iron condor. If you look at those red boxes there, we're selling the 140 puts and the 170 calls. That's where we're getting our premium. These are in July options, by the way. That's where we're getting our premium, but we're hedging our risks by buying a further out of the money put at the 130 strike and buying a further out of the money call at the 180 strike. So that defines our risk. So we know in this graphic here, if you look in the lower left where it says max loss of $8, in an absolute worst case scenario, we're dead wrong here, Straza. XLY either screams higher or crashes lower. Worst case scenario is we lose $8 on the trade. We don't want to lose $8, and we're going to hopefully get out long before that happens. But that's the absolute worst case scenario here.
So we are making the bet that XLY stops falling, correct?
We are making the bet. So why don't you pull up the XLY chart again? It'll make it a little bit clearer here. We are making the bet that the lows that happened about, I don't know, what's that, 3 weeks ago? Right around, I think it was 136 is the precise low there. We're making the bet that that low may not be the ultimate low, but it's going to be a low at least for the next few weeks. That's the bet I'm making, that low is going to hold. It might get tested, but it's going to hold for the next few weeks. And on the upside, where that gray area is, that's corresponds with about the 165, the 167 level. That's an area where the market has some memory. It was previous support. Now it's resistance. We think it'll continue to be resistance. So if XLY decides to move back higher, we think it's going to run into some trouble there. We're short at the 170 strike. So we have some room to be wrong here. But the bet we're making, Straz, is that XLY is going to stay above 136 on the downside, or it's going to stay below 170, at least for the next, let's call it 3 to 4 weeks. If XLY does that, we should have no trouble exiting this trade for a profit. I've got a resting order. I put on this trade today for a $2 credit. Okay. I think you might be able to get a little bit more for it right now as volatility's ticked up this afternoon. But we put it on for $2. That's how much we collected when we put the trade on this morning. I've got a resting good till cancel order to buy it back for a debit for $1. That means if I get hit and I get taken out at $1, then I've achieved half of the maximum profit potential in this trade, which is what I like to do with iron condors. I don't want to hold this position all the way until July expiration if I can help it. I don't want to carry the risk for that long. I'd rather just take my profit and move on to the next trade. And that's the bet we're making, Strazzy. Do you got any problem with that?
I kind of like it. I'll tell you why. Bring up a chart here. So if you look at XLY, if we were to zoom in on this little coil here, right? We had a little automatic reaction off the lows. Now we're coiling. Call it a little flag, right? Depending on what your time frame is. If I were to zoom in a ton on this, it's a little flag right there, right?
Yep.
And what we're seeing right now is a lot of these flags in the weakest stocks actually working higher. I would put XLY in that category. Discretionary stocks, like we've discussed, have been probably the weakest sector past few months. So here's ARK, what has been, the weakest area since last year. A longer coil, longer flag, resolving higher. We're seeing that in a lot of ARK-y names and indexes today. This got faded a little bit already today, but it looks like these things want to resolve higher. I would make the bet if the worst stocks are resolving higher from their short-term continuation patterns, XLY is probably following, and that would probably put us back towards this gray zone of interest, former resistance.
I like it, Straza. I like our odds here. We've got a risk management plan in place to get out if we're wrong. Like I said, if we break above 170 or below the lows of 136, we're not going to argue with it. Our thesis is busted. Win or lose, most likely lose. We're going to close the trade down and move on. Otherwise, if it stays within that range, we'll have no trouble hitting our profit target over the next few weeks. That's our trade. So to sum up, we're doing a July iron condor. We're selling the 130 puts. The 140 puts and selling the 170 calls. And we're protecting it $10 away on each side. So we're buying the 130 puts and buying the 180 calls. We put the trade on for $2. I think you can maybe put it on for a little bit more right now. Either way, we like the strikes. We like the odds. We like our chances.
What we're really doing is betting on more of a mess.
More of a mess, more of a consolidation. That's how we win. That's the bet we're making.
A lot of people want to know, when's the market going to bottom? Well, first, you don't just go from a downtrend to an uptrend, right? There's usually a period in between that's a sideways, messy, sloppy, ugly, base building, sideways trend, right? And selling premium is excellent for that kind of environment, which it looks like we're very much in right now.
Right on. Well, Straza, thanks for filling in for JC today. Usually JC does these calls with me on Wednesday. I know you got some work to do. You got to go see a doctor about that Keys disease. I got to get out of here and go on a hike with one of my friends from Trend Spider. So take care, everybody. Brandon, we're done. Pull the plug. See you next time.